Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 17th of July. I'm Daniel Lam, your host for the podcast. I was looking at a meme recently where it creatively reassigned the 9 movie titles of the Star Wars series to episodes 1 to 9. Now, the phantom menace of inflation is showing up in the latest US CPI figure. That led to the rise in the US 10-year Treasury yield, as it once again brings into doubt about the Fed's likelihood in cutting rates, as well as, of course, the concerns of the US fiscal deficit. Now, market narrative is often a case of looking at the same scenario, but interpreting it in different ways, as glass half full versus glass half empty. And these interpretations often come from catalysts. And we have 2 clear and present catalysts out there. So first of all is tariff. Since the sell-off on Liberation Day, investors have been taking a glass half full view of things. Now, TACO has become a consensus view. Expectations for where the average effective US tariff rate will end up in the medium term are all clustered around 16%, almost exactly where the rate set just prior to Trump's July 7th tariff letters. They're pricing in a rate that can represent the true floor for the administration, made up of the 10% universal baseline, plus sectorial, plus fentanyl tariffs. So this is actually susceptible to a turn for glass half empty, because the market is not indicating upside here, since Trump is unlikely to be reducing any of those 3 aforementioned core tariffs. The second catalyst is the US earnings season, which effectively started on Tuesday with the reporting of the mega banks, and they've been quite positive so far. There's strong earnings signal from M&A and equity underwriting businesses, plus decent growth in wealth management. And of course, deregulation is a key theme for the mega banks, freeing up their capital, which can be used for additional dividends and share buybacks. But the view on technology stocks and the company's soft comments will be critical to how sentiment may evolve. As we talked about last week, the US is looking to implement tariff on foreign companies in the semiconductor supply chain in a bid to encourage these companies to move their operations onshore to the US. So US companies can be indirectly affected by the tempering of the end demand. So how much this can impact the US consumers? How much can be passed on to them? And how this may be hurting companies' margins should the pass on be less than expected. All these are key questions that investors would be scrutinizing over these 6 weeks in the US earnings season. So all in all, there are enough quote-unquote question marks mentioned that we should continue to see some mild consolidation ahead in US equities. And investors should be looking to trim their excessive long holdings there. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.